Welcome to Lesson 8. Today's lesson is all about using a balance sheet to understand your business. Our two goals for this lesson are understand how to read your balance sheet and analyze your balance sheet to understand your business finances. A balance sheet allows you to fully understand what you own and what you owe. As the name suggests, balance sheets must be balanced. What that means is that the total assets must be equal to the sum of the liabilities and owner's equity. We'll look at all that in a second. You'll want to understand what your balance sheet shows about your financial status because you can use your balance sheet to make sure your business is headed in a healthy financial direction. Additionally, banks and investors will use your balance sheet when considering whether or not to give your business money. Just like we did with the income statements, let's take a look at an example of a balance sheet to really understand how to read it. The balance sheet we'll be reviewing belongs to Jill. Jill creates beautiful clothing, which she sells in her online store, along with working on commissions for custom orders. At the end of last year, this was Jill's balance sheet. You'll notice the balance sheet is divided into 3 sections: assets, liabilities, and owner's equity. You'll also notice that Jill's balance sheet is balanced because her total asset amount is equal to the total of her liabilities and owner's equity. When looking at the assets section of a balance sheet, you'll see 4 different items. First, the cash and cash equivalents is pretty self-explanatory. That's how much money is in the business checking and savings account. This can also include any investments you've made that will mature within 3 months. Next, inventory details the value of goods already in stock that are ready for sale. If you work in a service business, like writing or design, your inventory will likely be 0. Another item in assets is accounts receivable, which shows how much money is due from customers for work you've already done, including outstanding invoices. Finally, there's equipment. Sometimes these are separated out into long-term assets. If they are things that cannot be readily converted into cash, like computers, owned office or studio space, or manufacturing equipment. Next, we get into what your business owes, or its liabilities. This is broken down into accounts payable, which is how much you owe to suppliers for goods and services you've received, and notes payable, which is how much you owe them for loans. Sometimes short-term liabilities, such as credit card debt, will also be broken out into a separate category. Finally, we're left with the owner's equity section of the balance sheet. This shows how much of the business you own after all debts are considered. This includes common stock, which is the amount of money you and other business owners have put into the business, and retained earnings, which is the sum of all the profits you've made that have been kept in the business rather than paid out to yourself or other owners. Retained earnings may be different than cash in the bank since you've likely reinvested some of those profits into other assets for your business, like purchasing equipment or creating inventory. Additionally, when doing your bookkeeping, remember that personal funds taken out and put into your business always pass through owner's equity. You'll record these transactions either as an owner's contribution or an owner's draw. Owner's contributions include business purchases made with a personal card, as well as money invested into the business. Owner's draws include personal expenses, like money withdrawn from your business for owner pay that wasn't ran through payroll. Now that you know what to look for on a balance sheet, let's talk about how you can analyze what you see. When reviewing your balance sheet, you'll want to pay attention to a couple things. First, you'll want to make sure you're keeping up with everything and that the balances are correct. Again, if the sum of your liabilities and your equity don't add up to the same amount as your assets, then your sheet isn't balanced. If that happens, you'll want to look back at your bookkeeping to make sure everything is recorded accurately. Next, you'll want to keep an eye on how your assets and liabilities compare. If your liabilities surpass your assets, then your business is losing money and could be headed towards bankruptcy. It's also valuable to look at your balance sheet over time to understand if and how the company is growing. For example, let's compare Jill's year-end balance sheets from the past 2 years. By comparing the total on these 2 balances, Jill can see that everything appears to be going well. Even though her liabilities are higher because she took on a small additional loan in 2021, the investment seems to have paid off in increasing her assets and equity over time. You can draw these same types of conclusions by analyzing your balance sheets over time. I can't believe it, but you've already made it to the end of this course. I hope you found the learning valuable and easy to understand. I put a lot of thought into this course, and I know that if you put these lessons into action in your business, you can find success.